In this video, we shall illustrate to you the advantages of having excellent credit scores and the secrets on how you can achieve it. Secrets on John had been paying his bills on time, maintaining low credit card balances, and avoiding needless debt for years in an effort to establish a good credit record. His credit score was therefore above 800, which is regarded as great. The lender at the bank where John went to apply for a mortgage loan was rather thrilled by his credit score. He informed John that he qualified for their best deal, a fixed-rate loan with a 30-year term, with an only 2.5% interest rate. In addition, John asserted that he was exempt from paying origination fees, closing charges, or private mortgage insurance (PMI), all of which are frequently charged to borrowers who make smaller down payments or have poorer credit scores. John was thrilled by this offer, as it meant that he could save thousands of dollars over the life of the loan. For example, if John had borrowed $200,000 with a 4% interest rate and paid 1% in fees and PMI, I would have paid about $344,000 in total. But with my 2.5% interest rate, no origination fee and PMI, John would only pay about $284,000 in total. That's a difference of $60,000. John accepted the offer without hesitation and signed the contract. The lender congratulated him and said that he wished all his customers had such high credit scores. He also gave him some advice on how to maintain his credit score in the future, such as making my mortgage payments on time, checking my credit reports regularly, and disputing any errors. You want to be like John. This is good. Your credit score is a 3-digit number that lenders use to evaluate your creditworthiness and the risk of lending you money. It can affect your ability to get approved for loans, credit cards, mortgages, and other financial products, as well as the interest rates and fees you pay. There are different types of credit scores, such as FICO and VantageScore, but they all use similar criteria to calculate your score based on the information in your credit reports. Your credit reports are records of your credit history maintained by the 3 major credit bureaus, Experian, Equifax, and TransUnion. 5 factors that affect your credit score are: payment history. This is the most important factor, accounting for 35% of your FICO score and 40% of your VantageScore. It shows whether you have paid your bills on time and how often you have missed or been late on payments. Late payments, collections, charge-offs, bankruptcies, and other negative items can lower your score significantly. To improve your payment history, you should always pay at least the minimum amount due on time every month and avoid any delinquencies. Credit utilization. This is the second most important factor, accounting for 30% of your FICO score and 20% of your VantageScore. It measures how much of your available credit you are using across all your accounts. For example, if you have a credit card with a $1,000 limit and a $4,000 balance, your credit utilization ratio is 60%. A high credit utilization ratio indicates that you are relying too much on credit and may have trouble paying it back. To improve your credit utilization, you should keep your balances low and pay off your debt as soon as possible. Experts recommend using no more than 30% of your available credit, but the lower the better. Length of credit history. This factor accounts for 15% of your FICO score and less than 20% of your VantageScore. It reflects how long you have been using credit and how old your accounts are. Generally, a longer credit history shows that you have more experience and stability with managing credit. To improve your length of credit history, you should keep your oldest accounts open and active, as long as they don't have high fees or interest rates. You should also avoid opening too many new accounts at once, as this can lower the average age of your accounts. Credit mix. This factor accounts for 10% of your FICO score and less than 20% of your VantageScore. It shows the diversity of your credit portfolio and how well you can handle different types of credit. For example, having a mix of revolving credit such as credit cards and installment loans such as car loans or mortgages can boost your score. However, This doesn't mean that you should apply for credit that you don't need or can't afford. To improve your credit mix, you should only use the types of credit that suit your needs and goals. New credit. This factor also accounts for 10% of your FICO score and less than 20% of your Vantage score. It reflects how often you apply for new credit and how many new accounts you have opened recently. Applying for too many new accounts in a short period of time can lower your score, because it indicates that you are in need of credit or may be taking on more debt than you can handle. Each time you apply for new credit, a hard inquiry is recorded on your credit report, which can temporarily reduce your score by a few points. Make sure you collect your credit reports regularly and check for errors and irregularity. This is because your credit score may occasionally be unfairly lowered by errors or inaccuracies on your credit report. At annualcreditreport.com, you are entitled to one free credit report per year from each of the 3 major credit agencies, Equifax, Experian, and TransUnion. We hope you found this video helpful and informative. If you did, please give it a thumbs up and subscribe to our channel for more videos like this one.